Hi traders, this is Dr. Barry Burns with TopDogTrading.com, and today we're going to talk about candlestick patterns. Candlestick patterns are an excellent tool to add to your technical analysis toolbox. I use them, I like them, but today's video is a little bit of a warning, and it's because I find that a lot of, especially amateur traders, rely on them a little too much. Sometimes they rely on them exclusively, and they think that the signals generated by candlestick patterns, independent of other energies, just have a little more weight than perhaps they really do. So let's look at that a little bit today here, and I'll show you exactly what I mean. Now, this chart happens to be the E-minis. It's a 1,000-tick chart. But this could be any chart, any market, any time frame. Could be a daily chart of a stock, could be Forex. The principles apply the same to any market. And so here we have our candlestick patterns. For those of you who don't know, in this particular scenario, the way that these are colored. First of all, the reason that they call these candlestick charts is because for example, if you look at this candle right here, it kind of looks like a candle, right? This part is the body of the candle, and then you've got this little wick up here that you would light. So that's pretty much where the name comes from. And there's all kinds of very poetic terms applied to different patterns of candlesticks that we're not going to get into today. We don't have the time for that. But that's basically what a candlestick pattern is. So you've got the real body, which is colored sometimes, or sometimes it's solid and hollow. And then you get your wick that can be above or below. So the real body is the open and the close, and then your wick goes from the high to the low. In this case, because it's a red bar, mine's color-coded red, to mean that the close is below the open. So here's your open, here's your close, there's your high, and in this case the low and the close are identical. They're the same. Alright, on this one, this is called a doji, and doji means basically it opened and closed at the same price. And here too, open and closed at the same price but at the high. This one too, open and closed at the same price but at the high. Now when you get a green bar, it opened down here. There's your high, your low, and your open are the same, but the close is above the open, and so it colors it green. And that's how you know that it closed above the open. And the open and close, again, are marked by the real body, the colored part of the candlestick. Okay, so that's a quick little introduction, real basic stuff. But now let's get to the real point of today's video. So we've got a big gap here, and then we get a little bit of an up move. Now the question on these gaps is always, will it close or will it be a gap and go in the direction of the gap? So here we get a nice little up move, comes up a little bit below where or a little bit above where we opened for the day. Put it in kind of a spinning top, a doji, and then this is called a hanging. Well, this actually is kind of a reversal pattern. It's not a hanging man. A hanging man actually would have the real body at the top, and if it was down at the bottom, it would be a hammer. But what this represents, let me show you which candlestick I'm talking about here, just to be perfectly clear. There. So what this represents is we opened here, and we went up, and then we closed at the bottom of that bar. So in market profile terms, that's kind of representing a rejection of value, meaning that the market has attempted to go and close up here, but the market's rejected these higher prices and finally come down and closed at the low of the range, and that's considered a bearish pattern. All right, so let's follow through and see what happens. Whoops. Well, we had a bearish pattern, but now the very next bar is a green bar. That's an engulfing pattern. It engulfs the bar before it. That's a very solid green bar. Opened at the low and closed at the high. The range is pretty good. And so now all of a sudden it's looking like a bullish pattern, and maybe this gap will close. And then we get a more narrow range red bar, and then we get more of a little bit of a neutral bar. And again, we're staying all inside this little range here and still staying within the range. These are all pretty neutral patterns, dojis, and we finally start to sink down. So neither one of these patterns here, which were a little bit bearish and quite a bit bullish actually, neither one of those patterns worked out very well, and it just kind of gradually started to decline. And it's still going down and still going down. And now we get a wider range bar. This is a very bearish bar, opening at the high and closing at the low and being a wide range bar. Then a more neutral inside bar, another bearish bar, neutral doji type bar. Okay, so now we're really moving down clearly, turned into a gap and go. Okay, again, some neutral bars. Okay, now there is definitely a bullish pattern. And again, this is an engulfing type pattern. Our low and our high are engulfing the previous bar. And the real body, which is what really matters, well, your close of the previous bar and the open of the current bar are equal, but the close of the current bar is way above the open of the previous bar and way above even the high. So we get a wide range bar, closes toward the, or opens toward the low, and closes way up at the high. This indicates a reversal of this trend, and a lot of people would take this as a very clear reversal pattern and look to go long. Okay, so let's see what happens. We get an inside bar. We do get another nice little move up here, and then she starts coming down again. And in fact, we've come all the way down to this previous low, and now we've actually gone down below that low. So yes, we did get a reversal off of this low, if you can call it that, but it was very short-lived. In other words, the trend did not reverse. All it turned into was a very short retrace that only lasted really 1, 2, 3, 4 bars, but only the range was only one. That's an inside bar, so it was only 1, 2, and a little bit of a third bar. So very narrow range retrace. So even though you get the reversal pattern in the candlesticks, it does not really reverse the trend. It just starts a shallow little retrace up, and then comes back down and actually makes a lower low. So that's one of the important things to recognize about these candlestick patterns, is they are, in my opinion, very short-term signals. So I don't trust them for long-term reversals. I take them as very short-term signals. And then the other thing that's very important is you can't take them alone. We're looking at them in isolation here. And you can see that they haven't really been all that reliable. So why would I even use them? Because as part of a complete trading methodology, where you would look at other things as well, such as the trend of the market, the momentum of the market, support resistance levels, the next higher time frame. If you look at it in the context of those other energies, then it can be very helpful in finding some turning points. But just by themselves alone, not really all that significant. But that's not to say anything bad about Japanese candlesticks. In fact, that's true of everything in the market. I don't care whether it's a moving average or your MACD or RSI or Fibonacci levels or floor trader pivots. To me, none of them by themselves are enough to trade with. So candlesticks are an excellent tool, but only one piece of the puzzle, and you have to trade them effectively by putting them in the context of all of your other tools.